If I told you the next economic shock is already forming, not in headlines, not in dramatic crashes, but quietly, underneath the surface, would you even believe me? Because here's the uncomfortable truth. Major financial crises don't announce themselves. They build in silence. They form in spreadsheets, in balance sheets, in small shifts in credit markets, in subtle changes in behavior. And by the time the average person feels it, it's already too late to reposition. Over the past several weeks, I've been digging into US economic data, not just casually scanning headlines, but comparing today's conditions to the periods right before the biggest downturns of the past 50 years. The 1970s stagflation shock. The early 1990s credit crunch. The dot-com bust. The 2008 financial collapse. And even the rapid tightening shock of 2022. I wasn't looking for drama. I was looking for patterns. And what I found wasn't hysteria. It was structure. Certain dynamics that always show up before systems break. Now let me be very clear before we go any further. This is not, the sky is falling. This is not, sell everything. And this is not a prediction video. This is about probability. Because there is a massive difference between things feel expensive and uncomfortable, and the system is quietly becoming unstable. Right now, most Americans believe things are difficult, but stable. High prices, high mortgage rates, expensive groceries, tighter budgets, but generally stable. That's the surface story. Underneath, the stress indicators are flashing in ways that look very familiar. And when you understand how crashes actually unfold, you stop asking, will it happen suddenly, and start asking the real question. If it starts, how fast could it spread? So let's walk through the anatomy. No hype. Just mechanics. Because crashes follow sequences. And sequence determines survivability. First pressure point, debt growth versus economic growth. Every major crisis has featured one common imbalance. Debt expanding faster than productive output. When households, corporations, and governments borrow faster than the economy grows, the system becomes leverage dependent. Growth becomes artificial. Liquidity replaces productivity. Right now in the United States, total non-financial debt, federal, corporate, household, sits at historically elevated levels relative to GDP. Federal debt alone is above 120% of GDP. Corporate debt remains near record highs. Consumer credit balances have surged past previous peaks. Meanwhile, real economic growth is moderate, not collapsing, but nowhere near the pace required to justify perpetual debt expansion. Now here's the important nuance. High debt does not automatically cause crisis. The US can carry high debt. But when rates rise, and refinancing costs increase, and cash flows tighten, that's when leverage stops being manageable and starts becoming restrictive. And that's exactly the environment we're in. Second pressure point, household liquidity stress. Before 2008, households were over-leveraged on housing. Before the early 90s recession, rate spikes crushed adjustable mortgage borrowers. Before the 1970s stagnation spiral, real wages were getting squeezed. Today, the situation looks different on the surface, but the pressure is real. Credit card balances are at record highs. Auto loan delinquencies are climbing, especially among subprime borrowers. Buy now, pay later usage has exploded. Savings rates have normalized sharply from pandemic highs. Yes, household net worth numbers still look large. But that wealth is heavily concentrated in assets, particularly stocks and real estate. Liquidity is thinner than many realize. When a system runs on monthly cash flow, not accumulated wealth, small disruptions matter. A temporary layoff. A medical emergency. A 15% jump in insurance costs. A variable rate reset. And suddenly the margin disappears. That's not panic. That's math. Third pressure point, asset price disconnection. Now let's talk about the elephant in the room, asset valuations. Housing prices nationally remain near record highs relative to median income. The price-to-income ratio remains elevated compared to historical norms. And mortgage rates, although off their peaks, remain far above pre-2020 averages. This creates an affordability choke point. Homeowners who locked in low rates are staying put. New buyers face payment shock. Transactions drop. Inventory stays constrained. Prices resist falling. Until they don't. That stagnation phase is crucial. Because when transaction volumes fall before prices fall, it means the market is fragile, not strong. Stocks tell a similar story. Major indices remain elevated. AI-driven optimism, liquidity expectations, and concentrated megacap performance have supported headline numbers. But underneath, breadth has been thinner at times. Valuations in certain sectors remain stretched relative to earnings growth. And here's the key. When valuations rely on forward expectations that require perfect execution, the margin for disappointment shrinks dramatically. Fourth pressure point, credit tightening cycles. Recessions rarely begin with consumers waking up nervous. They begin when credit availability quietly shrinks. Banks today are far better capitalized than in 2008. That's an important structural difference. But lending standards have tightened in multiple sectors. Commercial real estate refinancing is under pressure. Regional banks face exposure to office properties whose valuations have declined significantly due to remote work shifts. Small businesses report more difficulty accessing financing. And when credit tightens, it acts as a brake. Fewer business expansions. Fewer home purchases. Less hiring. Less risk-taking. Which slows growth further. Which tightens credit further. This is how feedback loops start. Not through catastrophe, but contraction. Fifth pressure point, the Federal Reserve dilemma. Central banks often face impossible trade-offs before crises. In the late 70s, inflation versus recession. In 2008, financial stability versus inflation control. Today, the Federal Reserve faces a delicate balance. Inflation has cooled from its peak, but remains sensitive. Rate cuts too early risk reigniting price pressures. Holding rates too high for too long risk straining leveraged segments of the economy. Markets price in optimism. But policy decisions are never made in a vacuum. The Fed must watch labor markets, inflation expectations, credit spreads, global conditions, and financial stability simultaneously. If growth slows materially while inflation remains sticky, options narrow. And policy narrowing increases vulnerability. Now here's the part most people miss. Crises don't start with catastrophe. They start with stacked vulnerabilities. A soft housing market plus tightening credit. Plus mild unemployment increases. Plus declining commercial property valuations. Plus elevated government borrowing needs. Plus global uncertainty. None individually cause collapse. Together, they change dynamics. But before jumping to worst-case scenarios, we must acknowledge the differences from 2008. Because they matter. Banks are more regulated and hold more capital. Households locked in many long-term fixed mortgages. Labor markets have been historically resilient. Corporate cash balances remain substantial in many sectors. These buffers exist. And buffers buy time. So the real question becomes, What could turn vulnerability into ignition? Let's explore plausible trigger sequences. Scenario 1, the refinancing squeeze escalates. Over the next 12 to 24 months, large amounts of corporate and commercial real estate debt must refinance at higher rates than when originated. If property values decline while refinancing costs rise, certain borrowers become unviable. Defaults rise modestly. Banks increase loan loss reserves. Credit spreads widen. Lending standards tighten further. Economic growth slows. Asset prices begin adjusting downward. Consumer confidence falls. That's how tightening spreads. Not explosive. Progressive. Scenario 2, employment softens faster than expected. Even a rise from 4% unemployment to 6% changes psychology. More layoffs mean fewer new buyers. More financial caution. Reduced spending. Slower corporate earnings. Market repricing. And if layoffs cluster in high-income sectors, tech, finance, professional services, housing markets in key metros feel it first. Scenario 3, government debt pressure meets bond market resistance. If Treasury yields rise sharply due to supply-demand imbalances, fiscal arithmetic becomes more uncomfortable. Higher yields raise borrowing costs across the economy. Mortgage rates move up. Corporate borrowing costs rise. Equity valuations compress. Confidence wobbles. Scenario 4, external shock contagion. Geopolitical escalation. European banking stress. Emerging market sovereign issues. A liquidity event abroad that spills into US funding markets. The dollar strengthens sharply. Risk assets wobble. And domestic stress compounds. Notice something important. None of these require 2008 level fragility. They require alignment. If 2 or 3 of these occur in overlapping windows, the cascade accelerates. Month 1, mild economic weakness. Month 3. Lending standards tighten further. Month 6, asset prices soften 10 to 15%. Month 9, layoffs climb. Month 12, recession narrative solidifies. And here's the psychological tipping point. Early in a downturn, narratives lag reality. People say, it's a correction. Then, it's temporary. Then, it's more serious. By the time most accept the final narrative, valuations have already adjusted significantly. So what should you actually watch? Not headlines. Indicators. Watch credit spreads. Watch small business hiring trends. Watch commercial real estate delinquency rates. Watch the unemployment rate moving average. Watch Treasury yields relative to GDP growth. Watch corporate earnings revisions. When multiple indicators deteriorate simultaneously, not one, but clusters, that's when probability shifts meaningfully. Now let's step back. Is a crash inevitable? No. The US economy is large, adaptive, and resilient. Innovation cycles are strong. Energy production is robust. Capital markets are deep. This system can absorb shocks. But resilience does not mean invincibility. What matters most is your exposure. If you are heavily leveraged in illiquid assets with short-term cash needs, volatility matters more. If your job is highly cyclical, risk matters more. If you have minimal liquidity and high obligations, timing matters more. If you have long-term horizons, diversified exposure, low leverage, and strong cash buffers, downturns become uncomfortable, not catastrophic. And here's the reality most people don't like hearing. Preparation feels unnecessary, until it doesn't. You do not prepare because certainty is high. You prepare because fragility exists. You don't need to panic. You don't need to liquidate everything. But you should know your numbers. How long could you operate without income? How rate-sensitive are your obligations? How geographically diversified are your assets? Are you dependent on asset appreciation to remain solvent? Crises reward clarity. They punish complacency. Right now, the US economy sits in a late-cycle environment. Not collapsing. Not booming. Stretched. Balanced between resilience and pressure. The next 12 to 24 months will depend heavily on how credit, employment, and refinancing dynamics evolve. So here's the takeaway. Don't obsess over predictions. Track alignment. If weakening housing activity pairs with rising unemployment. If tightening credit aligns with declining corporate earnings. If bond yields spike while growth slows. That's when probability shifts. The question isn't, when is the crash? The better question is, if conditions deteriorate, am I positioned to withstand it? Because the difference between being prepared and being trapped often comes down to months, not years. Markets move first. Data confirms later. Narratives adjust last. And the people who survive downturns best are rarely the most optimistic or pessimistic. They're the most prepared. We are not in panic territory. But we are in a high-leverage, policy-constrained, late-cycle environment where shocks would travel faster than many expect. Watch the signals. Strengthen your foundation. Control your exposure. Because when the shift finally becomes obvious, it rarely feels gradual. And by then, repositioning becomes expensive. Stay observant. Stay analytical. And most importantly, stay ready.